Hi everyone, my name is Mickael Rogers. I'm one of the co-founders of Prop Hero. Thanks a lot for joining us today. All right, guys, we're going to start. Let me share with you guys what we are currently buying in Australia and where we are buying. So we have like three investment strategies at Prop Hero: capital gains, cash flows, and what we call hybrid. Capital gains, I'd say it's about 60% of what we buy. Houses in capital cities from 460K, very high capital growth, and like okay yield, like about 4.5% yield, but 4.5% today. And those of you who've invested with us, you know that 4.5 today, if rents increase, let's say by 10% per year, it means that after 1 year, you're at 4.9, 2 years, you're at 5.3, and after like 4 or 5 years, you're like above 6 or 7% rental yield. Hybrid, right now, as I was mentioning in the intro, we are buying townhouses, but only in very specific areas because we are seeing the opportunity there. Again, if you've bought a townhouse with us recently, you know what I'm talking about. High capital growth, right? Actually, we can actually find from 350,000 in some of our areas. So from $350,000, high capital growth, not as high as houses in the long term, but still high, and yield between 5.5 and 6% plus. Cash flows only in regional areas. It's about 10-15% of what we buy. Medium capital growth, right? So like nowhere as fast as what we are seeing in capital cities, but much better yield, like a 6.5 to 7% yield today. So typically what our clients do is that they start usually with the capital gains or hybrid type of investments, and then they diversify their portfolio with cash flows and again with hybrid, and then go back to capital gains. They just balance their portfolio to reduce the risk and also like to manage well their cash flows. So in fact, sometimes people hesitate between one strategy or the other. At the end of the day, guys, you are going to buy several of each, right? So it actually doesn't change that much. Even though, of course, yeah, you have to make sure that you don't buy something that is really like not fit for your financial situation. Where we are buying today, right now we buy in 104 suburbs located in 4 major cities: Brisbane, Townsville, Adelaide, and Perth. When I look at the numbers today, a vast majority of what we buy is in Brisbane and Perth. Brisbane, we are in 3 buckets: one small bucket in the north, one small bucket in the south, and one small bucket in the west. And in these buckets, yeah, you can still buy 5 or 6% below peak, but please don't get stuck on these numbers because yeah, in 3 months it will probably be at peak. So please don't stick too much on this gap to peak. In Perth, so we are again in 3, but much smaller buckets, and mostly east and south. Like a super small bucket in the north, but like really rare to find great deals there. So mostly east and south. Perth, so when I compare Brisbane to Perth, is that so in Perth we are getting properties from $400,000, higher yield than Brisbane, about 5%. 5.5 even sometimes in some specific buckets in Perth. So great yield in Perth, great capital growth. Still, we buy a lot in Brisbane because of the long-term capital gains. Brisbane, you've got a $55 billion infrastructure investment plan in place. You have the Olympics coming up soon. So yeah, like for long-term capital gains, Brisbane is the best area. But Perth is also great. It's not as good capital gains long term, but higher yield. So it kind of like compensates between the two. Townsville is you only want to go there for cash flows. And watch out, if you want to buy in Townsville without Prop Hero, please just be aware that about half of the city is in a flood zone area. So in a few years, it will be impossible to insure your property there. So if you buy by yourself, but yeah, just be careful because yeah, there are some amazing pockets where to buy in Townsville, but there are some very, very awful pockets as well. And as a fact, because some areas are bad, the ones that are good, we call them the oasis areas and are really good. But yeah, just watch out. Adelaide, we buy in two areas, north and south. But as I was mentioning at the beginning of this call, well, it's really, really hard now to find great deals anymore. Like prices are so high in Adelaide. It's still good, but yeah, like now we just don't buy that much in Adelaide anymore. And if you bought with us in Adelaide, well, good for you. I'm sure you're happy about your performance so far. Let me give you like a few real life examples. So Brisbane here, that's what we call a capital focused investment. It was bought 2 years ago for 497,000. The bank currently values it at 640, which is 143,000 capital gains in 2 years. And remember that in those 2 years, like the market allegedly, the market went down on average, right? So even though the market went down on average, we actually, so Mary experienced $143,000 capital growth. Rental return, when Mary bought this property, the rent was 380 per week. Tenants since then changed, and now it's 470. And the reality is that, I mean, the market rent now is probably 520 or something like this. So like the market yield is probably around 5.2%. Cash flow wise, so given her current loan and interest rates, it's minus 90 per week pre-tax. So post-tax, it's about minus 50 per week. So as you can see, like negative cash flows for this property. But again, her strategy was to go for a high capital growth investment. This one is a townhouse. And actually, it was bought by one of our team members, Luciola. Some of you must have talked to her. So she's a single mom. And what she was looking for was a hybrid investment. So great capital growth and great yield. So she bought this property 9 months ago for $360,000. The bank actually, and the last transactions in her complex were at 422,000. So capital growth of 62,000, so over 20% in 9 months. And what's great with her is that actually she's getting a 6.3% rental yield. So like very high rental yield. Slightly negative cash flow, so minus 70 per week, but after tax, it's about minus 40 per week, which was like exactly aligned to her strategy. And so when she renews the lease, so there were already tenants in, when she renews the lease with new tenants at market rents, the market rent should be around 480. So she should be, when she renews the lease, she should be cash flow neutral. And then when she increases again, she will be cash flow positive with great capital gains. Also, like what's great with this investment is that it's a townhouse in absolutely perfect condition. So it's what we call a set and forget, right? There is nothing to do on this property. Just take the rent, take the capital growth, and that's it. And so, yeah, so we buy a lot of these properties right now. Watch out though, we only buy townhouses in Brisbane at the moment because we don't think it's a great deal in other areas. I can talk more about it if you're interested, guys, or after this webinar. But yeah, just watch out. Some townhouses in some areas are like very bad investments, right? Because you have too many, there is too much supply, not enough demand. So yeah, it only makes sense in areas with like very specific characteristics around supply, demand, and the gap between the gentrification of the area and the price of houses. Anyway, it's a little bit complex, but yeah, so just watch out. Townhouses in some areas is like really not great deals. Really happy to have you all join this webinar. If you have any question, you also get a free investment session if you reach out to PropHero. So prophero.com or info@prophero.com. Thank you very much.